Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session. Wine, Beer, Spirits, Value, Growth, and Transaction Readiness. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to introduce today's presenters from Moss Adams, Derek Groff, Colten, Christianson, and Arnie McClellan. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Derek to get the presentation started. Derek?
Great. Thank you so much. Hello, everyone. My name is Derek Groff. I'm a director in our Valuation Services group at Moss Adams, where I reside in Colorado and lead our practice out in this region. Quickly, a lot of our kind of valuation work focused on food and beverage, and in particular, wine, beer, and spirits. It covers a pretty wide swath, so working with companies that are going through some kind of financing, equity or debt financing, maybe an M&A transaction, issuing stock or options to employees, as well as kind of litigation support, tax planning, things of that nature. And a pretty fair amount kind of litigation-wise is kind of partner disputes, shareholder disputes, distribution right disputes, things of that nature. So lots to cover and lots to do. It's pretty fun, pretty exciting. We like helping everyone achieve their goals and objectives. So as we kind of dive in, wanted to kind of cover, at least initially here, just some, kind of trends, kind of top level trends that we're seeing and observing, and our clients are kind of going through, working through, currently, if not, historically over the last year or two, as well as planning. So we've certainly seen kind of a big push. I'm sure a lot of you on the phone as well to direct to consumer, the DTC channel. So not just small producers and companies, but a lot of these larger kind of what we call kind of big box retailers, kind of getting into that game, if you will, to try to maximize profit, also kind of navigate some of the challenges existing in kind of the broader kind of U.S. and global economy as it relates to supply chain issues, raw material shortages, transportation costs, things like that. Even some of the larger kind of legacy brands, that you wouldn't necessarily associate with kind of direct to consumer. In e-commerce channels are focusing quite a bit on that. So these are, kind of at least on the food and bev side, Coke, Pepsi, Kraft, Heinz, Nestle, Tyson, Conagra, companies like that. And, you may not see that real easily, or, it may not be readily apparent as they kind of, buy companies and kind of continue to sell those products under those kind of prior, brands. There's also a lot of white labeling going on as well. So it is something that's going on, and is sort of a lot more prevalent than maybe it used to even 3, 4, 5 years ago. And certainly there's a big push for sustainability, right? I don't think that's unique to food and beverage or wine, beer, spirits. And I think that's a good thing for a lot of us, as individuals and consumers and humans and companies alike. So a lot of focus on, ESG, companies and products that are environmentally friendly, socially responsible, that are, regulated accordingly. You're starting to see a lot more of that. Not just focus, but also, a lot of the marketing and promoting that goes with it. And then, it's kind of associated with that a little bit is just this focus on kind of, healthy and convenient food and beverage options. You'll see a lot of, plant-based foods and beverages as well that, I think maybe 5 years ago or so, maybe even less than that, right? You didn't see that quite as much. So that's something that's still kind of building steam, and we'll probably see a lot more of that going forward as well. As it relates to kind of wellness and mindfulness, you're seeing that it's all kind of associated, right? In terms of, just, trying to be, healthier, watch what we're eating and drinking, putting into our bodies, trying to be better stewards of the environment, better to ourselves, and try to live longer, healthier, happier lives. And, I think, that in part is also leading to quite a bit of, growth for the industry overall, but a fair amount of M&A activity. So food and beverage has certainly been a sector that has been pretty active. Lots of deals that have been completed, big and small, over the last several years. I would anticipate that to continue, and in part probably keep valuations fairly high compared to other industries, and even compared to kind of historical averages for the industry, which I'll get to in a couple minutes as well. And then kind of within kind of the beverage kind of segment, which I'll get to a little bit more on the next slide, is just kind of continued growth in kind of the ready to drink, what they call the RTD category. So that's just, there's, kombucha, there's teas, there's canned cocktails, seltzers, all kinds of different things that, make it pretty convenient for people to grab and go. And also, kind of see what's on the label, and again, kind of better understand what the ingredients are and what they're drinking. And then there's just been and continues to be quite a bit of innovation on kind of the digital and technology side of things, and expanding what's been done historically. So I would expect that, just with technology kind of just being prevalent, right, and permeating throughout every industry and seemingly every facet of our lives, one way or the other. So there's a lot of innovation going on there as it relates to food monitoring, smart codes, temperature control, things of that nature. As we kind of get into the kind of wine, beer, spirits segment or subsegment of the food and bev category, a lot of this probably pertains to some of you on the phone, and certainly I would imagine a lot of you have experienced some of these trends and are part of that, part of what's going on. For example, this kind of wellness, healthy, movement towards kind of low to no alcohol Beverages is something that has grown quite substantially over the last several years. We call it, kind of the last 3 in particular, 2 to 3, and, kind of led by a number of companies. And the one that jumps out in my mind is kind of Athletic Brewing. That makes pretty tasty non-alcoholic beers. So for people kind of going through, dry January, for example, and wanting to, not kind of miss out on things, or still kind of, enjoy a beverage, during that month, or, after a workout or a marathon and things like that, that certainly has grown, quite a bit. And coming out of that, we're seeing more of alcohol brands, beverage alcohol brands diversifying across a number of different types of segments, certainly different types of alcohol, brands and things like that. So, whereas beer and craft beer in particular was kind of the showcase, if you will, in terms of growth, in kind of the 2010s or so, with 20-25% year-over-year growth, that is certainly slowed down and stabilized, and this kind of RTD category has really kind of taken off. A lot of times, though, that's kind of the canned cocktail. Cutwater spirits, for example, has grown pretty considerably, and I think we'll probably see quite a bit of growth there. And consumers, obviously driving a lot of that. Whether that maintains and persists, 5-10 years from now, sort of hard to know, but it does seem to have quite a bit of tailwinds behind there, just with consumers experimenting with new brands, different types of mixers. Obviously you got different bitters, and hard coffee, hard kombucha. There's the kind of cannabis, beers and cocktails and things like that that are new to market as well. And then there's this kind of concept of premiumization that's driving a lot of the growth and brand creation throughout the industry, and consumers and brands kind of moving upscale, up market. So sort of away from kind of the older stale, brands that maybe a lot of our parents' generation enjoyed. So there's a lot of excitement about new brands and innovation and development there, and price points, people getting comfortable with kind of higher price points. That being said, obviously inflation has entered the conversation, right, and is permeated throughout a lot of what we, see and do on a day-to-day basis. So, prices are starting to get pretty high in some categories and frothy. Some of that is obviously related to some of the supply chain issues, kind of going on throughout the industry and others, throughout not just the U.S., but the world as well, leading to higher prices and, things like delays and inventory shortages, access to raw materials, things of that nature. I would anticipate that to continue for the near term, which is frustrating, but I think everybody's trying to figure out ways to kind of navigate that on a kind of sector by sector and brand by brand basis. Valuation wise, multiples and deals have been pretty strong throughout kind of wine and spirits in particular. I think, beer has probably had the biggest challenges in the past several years, and valuations have certainly come down from sort of the heyday of 2010 to 15. But a strong brand is a strong brand, and people are going to pay for, good brand loyalty, customer awareness, profitability, growth, things like that, as well as kind of access to capital. Whereas some of the smaller, kind of less distributed, kind of less capitalized brands are still kind of having some difficulties kind of navigating that, especially as it relates to kind of, growth and profitability. Again, in light of kind of the high inflationary supply chain kind of issue environment. Just kind of a big picture perspective from the, global beverage alcohol industry is pretty large, compared to, a lot of other industries, 500+ billion in 2021, anticipated to grow about 10% in 22 this year, and then kind of a compound annual growth rate, or what we call a CAGR, of roughly 9.5% over the next 5 years to potentially hit kind of 800 billion or so. So it's a big business. Lots of big players, lots of opportunity, and still a lot of growth on the horizon. As it relates to kind of fundraising, which is obviously helping drive some of the growth and expansion brand wise into new markets and geographies and things like that, is capital raises from either private equity firms or venture capital firms. So you can see here, these are pretty sizable capital rounds, right? In total, in aggregate, on an annual basis. This is just U.S. only. So you can see here in 2022, kind of year to date is 55 million or so. I think that's going to, probably fall short a little bit of 2021, although that was a really big year. But compared to 2017, 19, and 20 maybe being somewhat of an anomaly of sorts, just given the challenges there that year, still quite strong, and anticipated to still have quite a few kind of rounds and funds being raised throughout this year, and not just in private equity, but also in kind of the venture capital realm as well. Certainly, there's fewer kind of smaller rounds, if you will. There's a lot more of them, but they're smaller rounds and smaller dollars in total. But we're talking about again, order of magnitude 50 to kind of 100 billion in total funds being raised to inject into new companies, new markets, new brands, things like that. So just with all this capital being raised and not fully deployed yet, we would anticipate quite a bit of growth that I kind of alluded to earlier on a previous slide, for not just the food and beverage category, but wine, beer, spirits as well. And that should also in turn kind of help keep a lot of the valuations fairly high. I think we have a polling question here. I'll turn it back over to Amy to handle.
All right, thank you, Derek. So the first polling question is, what best describes your current services? A, producer, B, supplier, C, wholesaler, distributor, or retailer, D, industry service provider, or E, other. And we will give you a few moments to respond. To respond to the question, just click the button next to the answer you choose and hit submit. And if you can't see the submit button, you will just need to enlarge your slide area. All right, it looks like most have responded. I'll leave it up for another 5 seconds. All right, Derek, here are the results.
Okay, great. So it looks like kind of spread out in terms of those, kind of actively involved in, the production, supply, or kind of distribution in the industry, as well as kind of service providers, and then this kind of larger other category. So it's interesting. Just kind of diving here into the kind of valuation kind of component. You'll see here kind of comparatively from a revenue or EBITDA perspective. So earnings before interest, taxes, depreciation, and amortization. Multiples and valuations have still remained historically, are pretty strong compared to historical averages. Revenue multiples continue to go up, and then in this past, kind of 6 months or so. EBITDA multiples coming down a bit, but still kind of compared to norms, pretty strong. Wine, beer, and spirits tend to generally, kind of follow these multiples. I would say, in general, that they're probably a tad higher when you think about a lot of the different brands and companies being bought. And then just from kind of quickly a public company valuation perspective, across the entire food and bev category, you'll see, on the left, you got kind of beverage alcohol here, 3-year average of about 16 times the trailing EBITDA, compared to kind of the current average of, kind of roughly 14.5. So as expected, right, just with some of the challenges in 2022, and inflation, supply chain issues, and so on, multiples have come down a bit. But compared to, kind of the broader market in the S&P, still, a bit of a step up, and kind of food and beverage overall, comparatively, a step up as well. And you can kind of see the dip between kind of the 3-year average and kind of current multiples. It's not quite as pronounced in kind of beverage alcohol or even kind of the overall food and beverage category compared to kind of the broader market, which in this case we're kind of just using S&P 500 as a proxy. So, again, this is just public companies. So companies are publicly traded in kind of the food and beverage or beverage alcohol category, not just in the U.S., but kind of across the world. So that's a little bit of a quick overview, industry kind of valuation, trend and pattern wise. Hopefully that's helpful, but happy to answer any questions that there may be at this time or at the end. So it looks like we have a few questions. Amy, is that correct?
Yes. Would you like to read them off, or?
Yeah, no, I can read. Okay. So first one, it looks like, is what is your view on the premium tonic sector? For example, do you think that Fever Tree can keep up with premium pricing and increase prices given high inflation rates? That's a good question. I'll be honest, I don't follow the premium tonic sector too closely. It does, coincide with kind of my earlier comment about, mixers and experimentation being increasingly popular. So I throw, tonic into that category with things like bitters and people making kind of craft cocktails. So I would expect them to continue to kind of command higher prices. In terms of continuing to increase prices, I mean, it's just sort of my opinion, but I don't see brands being able to continue to increase pricing across the board for every type of beverage or component when everything else seemingly is already expensive as it relates to, our other kind of food, bev, gas, lodging, rent, types of categories. Even though inflation seems to potentially be cooling off, it's comparatively very expensive. So I wouldn't be surprised if prices start to plateau a bit. But again, that's sort of just my opinion. One other question we have: have valuations in the wine, beer, spirits category largely follow broader food and beverage industry averages, or are there any nuances that are particularly significant? So I think I mentioned, I think they generally follow one another. I would say, it sort of depends on the category, right? So as I mentioned, beer, I think those multiples have come down pretty considerably, whereas wine multiples are still pretty strong, especially ones with, vineyards, in marquee appellations, and ones with, kind of premium, or ultra premium products. Sort of similarly in the craft spirit side, craft spirits, in particular things like, gin and bourbon and whiskey have been, pretty hot, as well as tequila in the last several years. And that really hasn't slowed down. So those have remained, very strong compared to historical averages, and certainly compared to, say the broader food and bev category. And I would sort of anticipate that to hold true for the next several years as well. I think that's all I see for now, Amy. So I think that does it for me. I'll turn it over to my esteemed colleague, Arnie McClellan. And Arnie, feel free to take it from here.
Great. Thanks, Derek. I appreciate it. Let me just advance the slides here. Hi, everyone. Good morning. I'm Arnie McClellan. I'm a partner in our transaction services practice and lead our M&A tax services for the firm. I just want to take a second to mention our capabilities as a firm in M&A. We have about 140 dedicated professionals. Probably 100 of those are on the financial side and perform the quality of earnings analyses for clients. About 40 dedicated on the M&A tax side, where we focus on structuring, tax diligence, et cetera. Our services are really split about probably 60%, 40% between buy side, sell side. We work a lot with private equity investors as well as corporate and strategic clients. Deep industry experience in this sector, as well as other sectors as well. But we have a number of partners that specialize in this industry. And then we've got deep technical functional expertise in tax, S corps partnerships, which we see a lot of in this industry, corporations, and then deep experience in state and local tax and other tax matters. And we're a 100% dedicated group. This is all we do for a living, is work on transactions. And my guess is we've probably worked on scores of transactions this year, in this sector. Amy, back to you for the polling question.
All right, thank you. So the second polling question is, given the current economic environment and political climate regarding tax legislation, are you considering selling your business in the next year or so? And if so, have you begun to think about the tax implications of a sale of your company? There are a handful of responses there for you to choose from. And then also, while you're responding, I just wanted to remind you that you do need to respond to at least 3 of the 4 polling questions to get CPE for today's webcast. All right, 5 more seconds. All right, Arnie, here are the results.
Okay, so it looks like we have a majority of folks that don't have any plans to sell anytime soon. Maybe some of those are buyers in the future, maybe not. And then it looks like it's spread, pretty evenly. Answer B, tax rate concerns. We saw last year that really driving a lot of activity, the potential changes in capital gains rates, going all the way up to as high as 40%. But that all of that, former legislation fell by the wayside, fortunately for sellers. And, C, not an uncommon answer. A lot of times people aren't thinking about tax, early in the process. They wait till later, as we see in D. And then, often people start to have very preliminary conversations with their CPA. And, often we find sometimes that can be helpful. It just depends on how experienced your CPA is in sort of dealing with M&A transactions at the time of the year. Often, CPAs will say, don't bother me during busy season. I'm trying to get the returns out. But it's good to start, these initial discussions with them. So I'll move it to the next slide here. let's see. Okay. So I want to kind of set the stage. What we're seeing in the marketplace is that, whether you're a buyer or a seller, investment bankers are being used predominantly in the sale process to manage it and guide the company and its owners through the process. And, typically it's an auction process or competitive process where the banker sends out materials in advance to interested parties, and they start a process where they begin whittling down potential bidders for the company, to try to maximize the purchase price. And, tax really needs to be part of this early process, because you get the maximum, you extract the maximum value in the best terms, during that competitive process. No different than really than sort of buying a house here in San Francisco. You create a lot of interest, a lot of competition, and then you get the terms you want, the most cash, quickest close, et cetera. It's no different with the sale of a company. And what we're seeing is a real focus, while the company is working with the bankers on the quality of earnings process, putting that book together, you need to really think about the desired tax structure and to start modeling that out to see what is going to produce the best after-tax proceeds for you. And so that includes the structure, and we're thinking about an asset deal, stock deal, tax-deferred rollover, notes, et cetera. Purchase price allocation, super important in this industry. Sometimes companies are on a cash method for tax, which can result in a lot of ordinary income in connection with the sale. Inventories or ordinary income property, they can be appreciated. There's depreciation recapture on plant and equipment that may have been fully deducted and depreciated under the recent legislation over the last few years. And then there's often credits, tax loss carryforwards, attributes, and transaction expenses that are created as part of the transaction, and those can no longer be carried back. They can only be carried forward. So another big focus is to try to monetize those, because you think about your company and the way buyers look at it. You look at it as a multiple of EBITDA, generally speaking, or a multiple of earnings. And if there are special tax attributes that are going to create value in a post-closing for a buyer, then you want to monetize. You want to get paid extra for that. It's not part of the deal. And so those are the types of things that we think about. And, this leads to higher proceeds, mitigating the taxes, and more take-home proceeds, after implementing these kind of terms into your deal. So again, very, very important to start this process before you enter into an LOI or a purchase agreement, because often if you wait, it's going to be too late. The train's left the station. There's often not much time to negotiate these kinds of things, and so you want to attack these things early. There's a significant amount of value in the tax savings in these transactions. A lot of the companies that we've seen in this industry are, organized as S-corps and partnerships. And again, that's an opportunity. Every buyer will look at an S-corp and a partnership as an opportunity to get a step up in basis. And we want to identify that early and try to monetize that value through the bidding process. As I mentioned, purchase price allocation, you want to pay tax on most of the allocation of the sales price at 20% capital gains rate, and you want to mitigate which gets taxed at the 37% rate. And we can help, work through that, again, early in the process. We're often now working in preliminary purchase price allocation methodology and concepts, but as the bids go out and as part of the bid, the bid purchase agreement that's developed by the lawyers. There's some planning that can be done around transactions that might involve the use of seller paper or notes to, again, mitigate the tax that recognized upfront and defer the maximum amount of gain that could be taxed in the future. We do a lot of modeling of these things. We find that clients and the investment bankers can help negotiate from a position of strength if we've got numbers to back up, what we want to ask for in the terms that we want. So we do a lot of modeling to evaluate the differences between different proposals that might be submitted by buyers, and then different purchase price allocation scenarios. So we run a lot of different sensitivity analyses around the bidding process to, again, arm the principals with the information they need to negotiate. As I mentioned, cash to accrual adjustments are often a big issue with companies that are on the cash method of tax reporting, even though they may be on the accrual method for book purposes. This is often a significant cost and something, again, to identify early and what the potential exposure is going to be. And then often we're negotiating, what I'd call a gross up payment or make whole payment. If a seller agrees to do an asset sale or a stock sale with a deemed asset sale election, there's a lot of that available. There's going to be some ordinary income. There's going to be some incremental taxes. We want the buyers to pay that and then gross us up for that. And there's a lot of things that can trigger that. Often these ordinary versus capital items. If you sell stock in your S Corp, for example, it's all capital gain, 20% end of story. But if you do an asset sale election, there could be some ordinary income items, as I mentioned, depreciation recapture, cash to accrual, inventory, et cetera. And so, we want to negotiate a gross up, on those items. And then state taxes is a big issue. We're seeing a lot of people, in low tax states. They may live in Texas or Florida. They may have moved there recently. And so if they sell stock, they're taxed on in the state where they live as an owner. And if you're in a low tax state, that's very attractive. Whereas if you enter into an asset sale or one of these special elections to treat the stock sale as an asset sale, then the gain is apportioned to all the states where the company does business. So there could be significant state tax leakage, and we can help, evaluate that. There's a lot of planning from an individual personal level. If you're an S Corp or a partnership, as most people know, as a result of the last tax act that was passed, effective 2018, there's a limit on deductibility of state income taxes at the individual level to $10,000. And so all of the states, or a significant amount of the states over the last few years, have been implementing legislation that allows for pass-through entities like S Corps and partnerships to treat those state taxes as a tax that's paid by the entity instead of by the individual. It passes through to the individual and produces a state tax deduction for all of the state taxes paid on the sale. These are often referred to in the press and the marketplace as SALT workarounds. It stands for state local tax workaround. And you say you were to sell your company for $100 million, and you implement this planning. Let's say your effective state tax rate was 9%. It could be different, be higher, be lower. But at a 9% rate, the savings, the federal tax savings of being able to deduct the state taxes on the gain would be $1.8 million, whereas without this planning, you'd be limited to $10,000. So significant opportunity there. We're also seeing, renewed interest in people looking to change their residency prior to a sale. It's not something you can do, a few weeks before entering into an LOI, but if the kids are out of the house and you're single and it's easy to move to Texas or buy a condo in Nevada and change your residency, again, if you can save the state taxes on a sale transaction, that can be significant. And then the other thing that we're seeing is a lot of planning around, partnership type transactions. And there's a lot of economic consequences to the allocation methodologies for income tax purposes. and related to the tax distribution policies of the company to distribute money so that the partners can pay their taxes on the flow-through income. And so we do a lot of modeling, et cetera, to help, again, understand the economic, consequences of these different tax choices that can be made. And again, it's something that you want to do early while you're negotiating so you have the most amount of leverage and can get what you want. And these allocations, have, capital gain versus ordinary income implications, and they have, true economic and return on investment implications. And we can help your team, negotiate these types of provisions. The last kind of holy grail of tax loopholes out there is this provision. It's considered a qualified small business stock provision. It's code section 1202. And it allows for 100% exemption from capital gains if you sell your company and it qualifies as a small business stock. Generally it has to be a company that is less than $50 million in value at the time it issues stock to investors, and requires a lot of planning up front because you have to set up the structure correctly in the beginning to get the benefit 5 years down the road. It requires a 5-year hold period, but there's a tremendous amount of value in situations where a private equity firm comes in, buys your business, and you as an owner or management team gets rollover equity in the transaction post closing, and we can structure into these types of transactions, allowing for that stock you received to qualify for this special exemption. Again, you pay no capital gains tax. It's limited to 10 million or 10 times your basis, the greater of, in a corporate transaction, but so it can be a very significant shelter on a go-forward basis in a transaction, something you should look at. Incentive compensation plan. We often find sellers in these transactions, promising key employees, I'm going to take care of you someday when we sell the company, but they never get around to really papering it. They will honor it. And the problem is that then those employees are going to end up with ordinary income treatment. And so there's nothing you can do a year in advance of a transaction because you need a year to get long-term capital gain treatment, and you don't want to issue equity or incentives right before a deal because the value is too high and it's going to be taxed at ordinary rates anyway. So if you're thinking about selling a company down the road, think about early how to get equity into your employees' hands so they can get capital gains treatment. And obviously, it's a benefit to the company to put those incentives in place. The other thing that we're seeing a lot of, very common in private equity structures and in partnership structures, is the use of the profits interest to reward management. They're very tax efficient, issued, tax-free, allows all the appreciation to be predominantly taxed at capital gains. Sometimes there's, 5%, a few percentage points of leakage to ordinary income, but you convert a majority of the gain to capital. So that's a very attractive way to incentivize management. Just going to touch briefly, sales side tax diligence. We're seeing a lot of focus on this. A lot of deals are being done with reps and warranty insurance. Buyer and their advisors are going to scrub. They're going to find the skeletons in the closet. You want to get ahead of those issues because they can result in delays in closing, reduction in purchase price, bigger escrows and holdbacks, and loss of confidence in the management team if these things aren't addressed and there's not a communication plan. Typical issues we're seeing, sales and use taxes. After 2018 with Wayfair, now all you need to get taxed is economic nexus. And so a lot of issues there. If you got B2C sales in foreign countries, VAT can be a problem. And then we see a lot of S-corps with problems with their qualifications. They've experienced foot faults, really makes buyers nervous and reps and warranty insurance providers nervous. Keep going here. I touched briefly on the reps and warranty insurance. I don't think we need to talk about that. And, in closing here, I think there's really 4 key points. Get your tax advisors involved early. Structuring opportunities can provide significant value in terms of maximizing your after-tax proceeds. Identify any valuable tax attributes that can be essentially monetized and paid for separately as part of the deal. Purchase price allocation, big issue in this industry. Don't wait till 60 days after closing to arm wrestle with a buyer over purchase price allocation. Let's get the methodology and the concepts in place in the purchase agreement. And let's identify the areas that are going to be problematic. We don't want to stick our heads in the sand and wait for it to come up. It will come up. I can guarantee that. Let's get ahead of it, plan around it, have a communication plan and a remediation plan to deal with it. And that's the key takeaways. This is just a takeaway slide. You can look at this at your leisure. Just really kind of identifies certain tax considerations throughout the transaction life cycle. And then I don't know, Amy, if there's any questions. We could save that till the end or respond by email. I know we've only got 14 minutes, and I want to make sure we give Colten plan to an opportunity to get through his materials.
Yeah, we're just going to move on with Colten's section, and then we'll pull all the questions at the end and follow up with the audience afterwards.
That sounds great. Well, thanks, Arnie. Thanks, Amy. And thank you, everybody, for jumping on with us for a few minutes. I know we only have, 13 minutes left, so want to be cognizant of your time, and we'll do our best to kind of get through this quickly and hit the high points, but feel free to follow up if there's any questions as we go along. By way of introduction, so my name is Colten Christianson. I'm a partner in our private client practice here at Moss Adams. My focus is on the transaction side, so I lead our transaction planning for, on the personal side for our business owner clients across the firm. So today we'd like to go through a little bit of the personal element piece of this, which it fits really nicely with what Arnie had mentioned, but personal elements of things you can be considering in advance and going through a transaction. So we'll jump right in. Similar timeline to what Arnie had mentioned, but personal planning, of course, for a business owner client, there's a lot of ties between your personal and your business balance sheet. And so as part of a transaction, which is incredibly complex, and for most of our business owner clients, they've never been through this before, but ultimately at some point a business will transition or transact. So understanding just kind of what's ahead and how to best plan for that, and having the right advisors around you that are coordinating and collaborating together. And the personal piece of that is incredibly significant. So the tax calculations that Arnie had described, what does that mean for you and your family personally? How does that align with your personal interests moving forward from a legacy standpoint, from a lifestyle standpoint, from a charitable and philanthropic standpoint? So we'll give you some thoughts on how best to do that, but ultimately considering your personal element as part of a transaction, every single phase of a transaction, and gut checking that throughout the process, having somebody that is your personal representative through that process is really, really incredibly important. And the earlier you can be thinking about that, we've seen be incredibly valuable for clients, and frankly opens up the doors to the number of planning opportunities that exist. Our first polling questions, Amy, I'll kick it over to you.
All right, thank you. So this polling question is, how early should you start building a plan for the transition or transaction of your business in the future? 6 months, 1 year, 3 to 5 years, or D, it's never too early? And while you're responding, if you would like copies of today's slides, you can download them from the folder that says slide deck and handouts right in your console. And then we're also sending them via email tomorrow along with the recording of this webcast. All right, most have responded, so here are the results.
Great, that's right. We'll dive into some of the, never too early, we'll dive into some of the details here. as to why that is, but it's never too early to begin kind of planning for these things. So I like this slide a lot. It reiterates a lot of what I had just said, so I'll move through this quickly. But essentially, with all of our business owners, there's two sides to kind of the picture here. There's of course the business aspect, both kind of operationally and through a transaction, has different stakeholders, employees, shareholders you're considering. There's things that we're going to want to address and plan for. And folks like Arnie and our corporate partners will drive a lot of what goes on that side of the house. Where we fit is on the personal stakeholder side. So how do those things tie to your beneficiaries, to your spouse, to charities from a legacy and wealth transfer standpoint? How are you taken care of in terms of lifetime cash flow post-transaction? So we'll dive into a little bit of that here. I included this slide because I think it's something for a lot of folks to be thinking about as you're targeting a transaction, but ultimately making sure that the services outlined here tie to each other, particularly as you're leading up and post-transaction. The one that I find most interesting, of course, personal tax. Arnie mentioned that we want to understand what a transaction will generate for a business owner and their family post-tax and what that allows you to do in your lifetime. The family office piece of this, I think, is huge. A lot of our business owners have relied on corporate resources for years, and following a transaction, many of those corporate resources go away. So thinking about what you find valuable out of that, and getting those things in place prior to or immediately following a transaction, so there's limited disruption there. But just kind of what is your life, and what does your team look like following a sale of your business? Wanted to walk through a little bit of our planning approach. This is a 30,000-foot level. I'll dive in a little bit more deeply over the next few minutes, but again, follow up if you have any questions. The financial planning term gets thrown around quite a bit for us, and it's certainly not a can I retire type of analysis. For most of our business owners, that, of course, is their reality. You answer those questions, but we instead view it as an evaluation tool through the transaction process. By that, I mean we are, in advance of a transaction, building out a summary or a projection around your current and future balance sheet. We're gauging your balance sheets, both current and future, ability to meet all of your kind of lifetime consumption goals. I'll walk through that a little bit in the different buckets that we think about that. But then ultimately what's left over in terms of a remainder and what your options are and where those things will go. The takeaway here and the reason that we plan this way is you have this framework that you then built out and are able to, as LOIs come through, evaluate offers net of tax real time and what options it creates for you and your family. It also, if we have an understanding of the excess that's expected to remain, which most of our business owners have as they embark on this process, there's an excess left over that is expected to not be spent during their lifetime. So what are the options that we can, planning opportunities and options that we can consider that create tax benefits, but ultimately the main driver of that is just what does your family prioritize and what types of things are you interested in? So the first step of that process is modeling some lifetime consumption needs. So we work with our clients to think through what kind of the next step looks like. This is certainly not, nobody likes to go through a budgeting exercise, particularly going through a transaction. So this is certainly not that, but we are working through kind of higher level ballpark figures that are conservatively high that we think our clients will spend, and the types of things that they want to do, whether that would be just daily living expenses or travel or vehicle purchases that have been run through the business in the past, college expenses for their kids or their family members, etc. So looking at what dollar amount, if we project forward, will be required to retain personally and cover those expenses for the rest of your life. I mentioned the last bullet point there, I think, is the most important, but deal evaluation. So having this framework built out in advance of a transaction allows you to kind of update this real time and consider the personal elements of a deal that's coming across the table. from that standpoint. But ultimately what this does is create peace of mind. So you know exactly what I need to, at a minimum, sell this business for to allow me to do all the things I want to do. And then, of course, if excess is available, then it opens up other doors from a planning standpoint. Which leads me to step 2. So with the remainder, that first graph I showed, there's always a remainder. If there's a remainder and it's above $24 million, which is the estate exemption as of today, roughly, and is expected to come down, that's the amount you and a spouse can leave tax-free to your heirs. That's expected to sunset in 2025. So any amount over that you would expect real estate or liquid portfolio to have, any amount over that is going to get taxed at 40%. And so what are opportunities that align with your interests, which should be the first driver, align with your interests and align with what your family wants to do and intent and prioritizes, that can also create tax benefits. So transactions represent generally one of, if not the highest tax year that you'll experience. And so that creates opportunities on the charitable side, either through vehicles like a charitable remainder trust or a donor advised fund that allow you to capitalize on a larger donation that you would have otherwise given anyway, and sometimes spread that donation out over your lifetime. Or on the gifting side, if there's things that you're gonna gift to heirs, I'm not necessarily saying you could certainly do this, but gift millions of dollars away to those folks. You can control the timing around that and put the framework in place that you're comfortable with. But there are potentially opportunities if you get this early enough to be able to do some gifting to your heirs and create tax benefits that otherwise would have been given anyway. So if you understand the excess, you can feel comfortable around the amount you're giving, then it's not going to impact your daily living expenses. Quick polling question here. I think it's our last one. Amy?
Yes, so the last question is, what types of planning opportunities exist as part of a transition or transaction? A, philanthropic, B, estate, C, legacy or wealth transfer, or D, all of the above? We'll try and move through this one pretty quickly here. A few more seconds. Okay, here are the results.
Nailed it. That's exactly right. So number of opportunities that exist, again, intent should drive that, and ultimately there are generally tax benefits that result, just not letting the tax dog or tail wag the dog there. So ultimately having a discussion around your family's priorities first. But if in advance, if you can, and by that I mean several months, if you received an LOI, your planning opportunities shrink. So the earlier you can get at this and start to plan, the better. The third step is just setting wealth allocation targets. So each of these buckets that you create, lifestyle, for charity, for legacy, for your kids or heirs, can and should be invested differently, each with different risk profiles that align with the timeline for the use of those funds. So just being thoughtful around that, and in a lot of ways can allow you to grow your wealth more quickly. If you can allocate your dollars that are intended for your lifetime spending a little bit more conservatively and take a little bit more risk for dollars that are intended for your kids that are younger and not going to touch those dollars for several years, you can grow your balance sheet that way. So being thoughtful around that, not just throwing everything in one bucket, intentional about the strategy there, we think is really important. And then just set the annual roadmap. This isn't a snapshot in time. This is something that should be reviewed as part of a transaction, but after a transaction, and having the right team to help you implement that plan following a transaction, just execute on the things that you've talked about and put in place, and reviewing that on a frequent basis should be the driver of kind of the investment strategy moving forward. One couple more slides here. These are just interesting kind of things to be thinking about prior to a transaction and during a transaction. I highlighted a few that I thought are really interesting, that we often we work with our clients on, but go unnoticed. So have a leaning account open for the proceeds of the transaction. Don't have the funds hit your bank account from an FDIC perspective. Have an investment account open that has other insurance in place. And then you can start segmenting the dollars out. Dollars that are projected to go towards tax, you can invest them conservatively. Interest rates have risen. Treasuries are paying you something these days. So be strategic about dollars that might not be yours. Of course, they need to be set aside safely, but there are strategies out there that you can implement and take advantage of some of those things. So I'll stop there. I'll kick it back to you, Amy. But feel free, like I said, open invite, shoot me an email afterward on the personal side. There's anything that I can do to help her, any questions that you might have.
All right, thank you, Colten. Yeah, unfortunately, we are out of time, but go ahead and reach out to our presenters if you have any questions or would like to cover more information. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. Email will be sent out within 3 weeks with a copy of it should you have difficulty downloading it now. And finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.